Today, we're going to talk about something that can have a big impact on your financial life: net worth. Now, you might have heard this term before, but what does it actually mean? And more importantly, how can you calculate it? Well, that's exactly what we're going to cover today. So stick around because this is going to be really useful information. Net worth is one of those financial concepts that sounds fancy, but it's actually pretty straightforward. At its core, net worth is simply the difference between what you own and what you owe. It's like a financial snapshot that shows you where you stand at any given point in time. This is crucial because understanding your net worth can help you make smarter financial decisions and plan for the future. So, let's start with the basics. To calculate your net worth, you need to know two main things: your assets and your liabilities. Your assets are everything you own that has value. This can include your savings account, investments, your home, your car, and even smaller things like jewelry or electronics. Basically, if you can sell it for money, it's an asset. Liabilities, on the other hand, are everything you owe. This includes your mortgage, car loans, student loans, credit card debt, and any other type of debt. Think of liabilities as the financial obligations you have to pay off. Now, to figure out your net worth, you simply subtract your total liabilities from your total assets. So, for example, if you have $100,000 in assets and $50,000 in liabilities, your net worth would be $50,000. Pretty simple, right? But why does this matter? Well, knowing your net worth gives you a clear picture of your financial health. It can help you identify areas where you might need to make changes, like paying down debt or increasing your savings. Plus, tracking your net worth over time can help you see your progress and stay motivated to reach your financial goals. So then, let's break it down a bit more. First, let's talk about assets in more detail. When you're listing out your assets, be sure to include everything you can think of. This includes not just the obvious things like your bank accounts and investments, but also things like the value of your home and car. If you own any valuable collectibles, such as art or rare coins, those count too. And don't forget about your retirement accounts. Those are a big part of your financial picture. Speaking of which, estimating the value of some of these assets can be tricky. For things like your car or home, you might want to use an online estimator or get a professional appraisal to get a more accurate number. For your investment accounts, you can usually just use the current market value. Next, let's talk about liabilities. This part can be a bit of a downer because it involves looking at all the money you owe, but it's a crucial step. Make sure you include all your debts, including mortgage, car loans, student loans, credit cards, personal loans, and any other debts you have. It's important to be honest and thorough here because underestimating your liabilities can give you a false sense of your financial health. Now that you have a list of your assets and liabilities, it's time to do some simple math. Add up the total value of your assets and then add up the total amount of your liabilities. Subtract the total liabilities from the total assets, and voila, that's your net worth. But calculating your net worth is just the first step. The next step is to understand what it means and how to use it to your advantage. If you have a positive net worth, that's great. It means you own more than you owe. If your net worth is negative, don't panic. It just means you have some work to do to pay down your debts and build up your assets. Another thing to consider is how to improve your net worth. There are two main ways to do this: increasing your assets and decreasing your liabilities. Increasing your assets can involve saving more money, investing wisely, or even starting a side hustle to bring in extra income. Decreasing your liabilities, on the other hand, involves paying down debt and being mindful about taking on new debt. One strategy to increase your net worth is to create a budget and stick to it. This can help you control your spending and find extra money to put towards savings or debt repayment. Another strategy is to automate your savings so that a portion of your income goes directly into a savings or investment account each month. This way, you're building your assets without even thinking about it. On top of that, consider the power of compound interest. When you invest your money, it can grow over time thanks to compound interest, which is basically earning interest on your interest. This can significantly boost your assets over the long term. Paying down debt is equally important. High-interest debt, like credit card debt, can really eat into your net worth. Make a plan to pay off your debts as quickly as possible, starting with the ones with the highest interest rates. This will save you money in the long run and improve your net worth faster. Another important point is to review your net worth regularly. This isn't a one-and-done calculation. Your financial situation can change over time, so it's a good idea to check in on your net worth at least once a year, or even more often if you prefer. This will help you stay on track with your financial goals and make adjustments as needed. Now, let's talk about some common mistakes people make when calculating their net worth. One big mistake is not including all assets or liabilities. It's easy to forget about that old savings bond or that small personal loan, but every little bit counts. Make sure you have a complete picture to get an accurate net worth calculation. Another mistake is not updating asset values regularly. The value of your home or car can change over time, so it's important to keep those numbers current. This will give you a more accurate view of your financial situation. Also, be careful not to overestimate the value of your assets. It's natural to want to think that your home is worth more than it really is, but it's important to be realistic. Use market data and professional appraisals to get accurate values. Speaking of which, don't forget to include your intangible assets. This can include things like intellectual property or the potential value of your business if you're an entrepreneur. While these can be harder to value, they're still an important part of your overall net worth. So then, how does your net worth compare to others? Well, it's important to remember that everyone's financial situation is different. Comparing yourself to others can be useful for context, but it's not the most important thing. What's more important is tracking your own progress and working towards your own financial goals. In addition to that, remember that net worth is just one measure of financial health. It's a useful tool, but it doesn't tell the whole story. Other factors, like your income, expenses, and financial habits, also play a big role in your overall financial well-being. Now, I know this can all feel a bit overwhelming, but take it one step at a time. Start by calculating your current net worth and then make a plan to improve it. Even small steps, like cutting back on unnecessary expenses or setting up automatic savings, can make a big difference over time. So, understanding and calculating your net worth is a key part of managing your finances. It gives you a clear picture of where you stand and can help you make smarter financial decisions. Remember to be thorough and realistic in your calculations, and use this information to set goals and track your progress. If you have any questions or thoughts, feel free to share them in the comments below. Take care and keep working towards those financial goals.